Good morning, Steve Ray in Chicago with the morning grain comments. Markets are a little bit lower overnight, except soybean oil and Minneapolis wheat are higher. I think in the wheat market, we're not seeing a lot of new news, and so you're seeing maybe a round of profit taking at some key resistance levels, especially in Kansas City wheat. On the negative side, still looks like there's some Russian wheat being exported, which keeps world prices, at least their prices, a discount to U.S. Here in the U.S., it looks like we're going into a drier and warmer trend with wind in the southern plains. Now, we're in this change of pattern in which we're building a ridge, breaking a ridge, building a ridge, breaking a ridge before mid-May the ridge becomes more established. So whenever the ridge breaks down, there's a chance of light showers moving across the hard red winter wheat belt. But many are predicting that crop ratings are on the decline for hard red winter wheat, and talk of lower harvested acres is also increasing. Also in the wheat, Canada is wet and cold, especially in eastern prairies. That could delay plantings there. We're seeing the rapeseed contract new crop in Canada making new highs. We're also seeing Minneapolis gain on both Kansas City and Chicago because of this increased wet, cool weather pattern. In the Midwest, we could actually start seeing a little bit of a change from this wet, cold weather pattern to maybe a little bit drier and warmer. It should allow for the corn crop to get planted. The question is, what is the yield potential after that? Some feel that west of the Mississippi, that ridge that will finally develop in the southern plains will move into the western corn belt and may reduce chances of getting that 180 corn yield that we need to at least keep the carryout around 1.2 billion bushels for 22-23. Ukraine war continues, raises question about their corn exports and how many acres they're going to actually plant in corn this year. And so we'll be watching to see if we pick up any export demand from there. We're also noting that the dryness in central Brazil could be reducing their second corn crop, which could also limit their exports. And we expect domestically ethanol and feed usage in corn to rise. So I think the corn market at $8 is still pretty friendly. Over in the beans, again, watching pretty closely China buying. We are competitive August forward versus South America. It's just that right now, 1/3 of China's population is locked down, and that's more than the entire U.S. population. So we're concerned about their domestic food consumption, energy consumption, their import demands of grain and energy, and what that could mean to the prices. But I think they still have to buy beans for import. Just the question mark is, do they need corn? And then how does that all affect things down the road if China and U.S. relations begin to sour? So we'll be watching any headlines from the Ukraine war, watching any comments by the Fed today as far as interest rates are concerned, and we're watching money flow. We did see yesterday a rally in corn and beans might be linked to short covering of short call options, and we also are watching pretty closely something called VAR, in which the funds reduce their risk if price exceeds value.